All right, guys, welcome back. Welcome back. This is going to be part two of the structuring high probability trades or structuring trades for favorable outcomes. If you haven't watched part one, I recommend that you go watch that first. You'll see this in there and explain what this is, but it's pretty self-explanatory. So we're going to go over how you structure your trades, the options that you have when you're structuring your trades and you're looking at a chart, and what makes something high risk or low risk or high probability and all that, okay? So we're just going to move this to the side real quick. So I have a chart here in the background, and I've just put in some trade ideas for this chart. Now, we're all looking at the same chart, right? There's so many trades. You really could take a trade in either direction at the close of every bar, okay? And it would be a probability really associated to that type of trade and the type of risk. So let's start here with this low risk, medium probability long here. Okay, so where's that at on this chart? We have low risk right here, medium probability long, so it's green. Okay, probability is medium that it might work out in your favor, and the risk is low, so you're right here. Okay, we get that? So what makes this trade here that type of trade? So you could see that price is coming from sort of an uptrend. It dips down here. Okay, it dips down here. Comes way below here. Rallies up. Comes down below the this is the 20 period on here. Comes down, makes a low, then makes a higher low. It's only higher by a couple of ticks, but it's a higher low. Then it rallies up and breaks the 20 period moving average, okay? You could potentially say, okay, I'm going to go long. I'm going to go long when this 20 period moving average, when this price trades above this candle right here. So you enter long. Where would you put your stop? Probably. Did I put probably on all these? No, it's supposed to be probability. Anyway, I'm not going to change it. You know what I mean. So low risk probability down here. It's a medium, it's a low risk trade because from here to here is not a lot of points. From here to here, you're risking only 5 points, okay? That's a five point stop. And it's low risk, or it's medium probability because this just shifted to an uptrend, okay? You just had your first lower high and higher low. See that? You had a low, you had a higher high, you had a higher low, and then you had a higher low here forming, and then you came up here. This hasn't happened yet, this bar right here. So where would your stop be? Your stop could be here if you want it really low risk. You say, okay, if it takes out this candle here, I'm out of the trade, and that's even less than 5 points. That's 4.5 points. But logically, you would really want it here. Because if it breaks back down, the next big bearish symbol or sign that they want to go lower is going to be breaking this low right here. Okay, so that's what makes this low risk because it's only 5 points that you're risking. And medium probability, it's not super high probability because you just came from a downtrend. You just came from a situation where there were lower highs, okay, and where there were lower lows. This low was low. We broke below here, we rallied, broke below here, we rallied, broke below here. Okay, so you just came from a downtrending situation structurally. But because you are above the moving average, okay, you're above the moving average, you're buying on a stop. So you're saying when price trades above this candle, I'm going to be in. Buying on a stop is always higher probability than buying on a limit, right? Because you're buying in the direction that price is already moving, okay? And your risk is low. It's low risk because down here you're only risking 5 points, and you're pretty sure if price comes up after this candle and breaks down, it's probably going to go down for another leg, okay? And so we saw that trade did work out. On top of that trade, though, moving up a little bit higher here, you have a low risk, low probability short, okay? What makes this low probability, low risk? So if you were to say, okay, I'm going to short this market after this big red candle. So we had a rally up past the 20. We retested the 20 here, and then we pushed back up here. We got to the, so at one point this bar right here was solid red, right? At one point this bar was solid red. I'm sorry, this bar was solid green, my bad. At one point this bar was solid green from open here all the way up here, okay? So this bar was solid green. They came back and pushed it all the way past the open to the close. Then they pushed off the bottom a little bit, but long wick at the top, and you have your open here and your close down here. That's a really good bearish symbol. So you could say, okay, I'm going to short this market if it comes back up here. I'm going to short this market if it comes back up here. Okay, that would be a low risk, low probability short. Okay, let's take it first. Why is it low risk? Well, it's low risk because you're only going to short this candle right here, or you're only going to get out. No, hold on. I'm doing this wrong, guys. I'm sorry. Your short should be down here. Your short should be right here. I had this in the way. Okay. Your short should be here if this red candle trades below here. Okay? It's low risk because you're only risking this candle, and this is a 2-point candle. But it's also low probability because just now we've had a retest of this. We've already retested this moving average. We tested it here, we broke up against it, we came back, tested it here. You've come up and tested the top, okay? But the bulls haven't had a chance to try again, and we know that typically the market likes to do something two to three times, and then it'll try to do the opposite, right? So you've only tested this top once. I would expect this to be tested again before I'm trying to go short below this bar. It's low risk because you have the probability of this trade, the probability of this trade working out and it breaking down below the 20 and then down below the last swing low is a low risk event right now. It's more likely that it's going to continue because we're in an uptrend. We can even draw a trend line up now at this point. You had 1 touch, 2 touch, really 3 touches if you look at this as a zone. And you're shorting it right here. This would have never been filled though. Okay, this would have never been filled because we never traded below it. But you even thinking on this trade, thinking to take this short, you're thinking in a low risk, low probability way. And where is that on the chart? Low risk, low probability. So you're over here. So this should really be yellow right here. Because it's not a terrible trade. You could think of going short here, and if it tags you in, you'd only take a 2-point loss. But you could avoid this loss completely by realizing that, okay, I should probably be long here. All right, I should probably be long here because we've already rejected this bottom twice. Okay, and the bulls have not tried again to get up here. So for me, that's a low probability short, but it's also low risk. So it's not going to hurt you too much if you're wrong. All right, but you really shouldn't be thinking long at this point. You've got too much, or short at this point. There's too much of a barrier between, you have a trend line, a moving average, you have a structure. That's too much to try to get through when you're just now starting an uptrend. Okay. All right, so this here, put that back there. Moving on up, another trade I spotted here. This is a high probability, low risk long. Okay, so you're here on this thing. You have high probability and you're low risk. Okay, this is probably one of the best trades that you can take because what's happening here? You're entering at when price closes above this. So you could take it to the body if you want. Okay, but I like the wick. I like to see them take out all the sellers that sold. So you're going long when the candle passes up against here. You're putting your stop below this candle. Why is this high probability? Okay, this is high probability because you have the moving average below, okay, and you just tested it with a swing low. Okay, this swung low was bought back up. This wick is almost 2 times as big as this candle right here. And then when you take out this, it's like this wick never happened. Okay, because they bought it up again. So it's high risk and low, I'm sorry, it's high probability and low risk because you're only risking, once again, the bottom of this candle. Okay, now this is about 11 points. Okay, this is about 11 points. So depending on, how big your account is, it might be high risk. But here's the thing. You're shooting for, if you're doing this, you're shooting for probably a point, 1.5 your ATR. That's about 15 points, 16 points, right? So it didn't look like you get there. But you don't know how far this is going to go. Your only job is to structure a trade when you enter the trade. Because like we said in the last video, your probabilities of outcomes changes as the trade progresses. As the trade matures and you really get into holding it, your probabilities and your risk are going to change, okay? So your job is to just find situations where you could potentially catch a big run to the top, but if you're wrong, it's not going to hurt you that much, and it's probably going to be an area in the chart where sentiment is going to change, where everyone's going to see, okay, something's different here. When you break this candle here, after you've tested the 20, when you break this candle low, you're also going to be breaking the low of the 20, okay? And you're coming back down to this trend line. So it's lower, it's high probability that this is going to hold, that they're not even going to want to try this, okay? And it's low risk because you only have this one candle here. Moving on up here, we have a low risk, low probability, low risk short, okay? So where are we at? Low probability, low risk. Again, we're right here again in the yellow. So this should be yellow again. Let's make this yellow again. I'll just make the line yellow. All right, so we're in a low risk, low probability short right here, okay? You decide to go short once you break below the structure of this, or you could actually put it here once you break below this candle, and you're putting your stop up here. Now, what makes this low probability? It's a low probability because this is a short and you're in an uptrend, okay? You are shorting right where you would expect it to bounce again, like it has the previous two times. It bounced here, came down and tested, it bounced here, and then, so chances of it bouncing here in an uptrend are stronger than the chances of it breaking through, okay? And you see it wasn't really a clean break. It kind of broke through, retested you here. You weren't in that much of a drawdown, okay? But it retested and then it fell away. So this is actually, well, we'll get to that in a second. But so this is low risk because at the top of this range, you're looking at about 9 points. So you know you're wrong if from here it comes down a little bit and then boom, comes back up through there, okay? The uptrend has continued. You've hit the 20. And you've went up. That's what makes it low probability because the probability of it breaking down here is lower than the probability of it continuing. Okay? So that's low risk because you only have a little bit of risk here. And it's also low probability because you're shorting in a downtrend. All right? And you're above the 20 and the last two times you bounce at the 20. All right, we're going to keep moving on. This is going to be a low probability, low risk long. So low probability and low risk. We're right here again. This should be yellow. I think I made it green to show that it was long. But, okay, so this should be yellow. Okay. You're going to enter your long right here. You're going to enter your long right here when this candle trades above this candle. Okay. This is low probability here. Low probability here because now we're in a confirmed downtrend. Okay, you've had a high put in. They tried again here. This is a lower high. They came down. They tried again here. A lower high. They came down. They pushed up here. Okay, they pushed up here, and you want to enter right here because you think this is going to break through this. So not only have you had lower swing lows and lower swing highs, all right, but now you're below the 20 period moving average, okay? So the chances of this working out, the probabilities working out that this is going to just reverse up, they're way lower than they would be if you had said, okay, I'm going to buy up here. Had you just moved this and said, okay, I'm going to buy up here, this now becomes a high probability, low risk long. Okay? Because your stop is still relatively small. Okay, your stop is only 9 points. And you now have seen them able to push above the last swing high. Okay? But with this entry here, you don't have that option of seeing them have the strength to push above this last swing high. So this makes this low probability. You're below the moving average. You have multiple lower lows, multiple lower high. You know what I'm trying to say? Multiple lower highs and multiple lower lows. And you put your stop below here, so this what makes it low risk, but it still makes it low probability. All right. Moving on down here, we have a high probability, low risk short, and that's right here. So right here, high probability, low risk short. What makes this high probability? Well, a lot of the things that just made this low probability for a long make this high probability for a short. Okay, you have now, even with this, you have a breakdown. You're entering right here. Okay, you're entering right here. All right, when this comes up and falls away, this is where you're deciding to go long. You have this big bar here, this 7-point bar. Okay, 7-point bar, and you put your order here. When you guys see a big bar on the chart, okay, it's always high probability to do what that big bar is doing. Okay, because in order to move the market in that way, that took a lot of size, it took a lot of momentum, it took a lot of conviction for someone to step in and say, okay, we're getting ready to slam this market. And to create a bar like this that's bigger than pretty much every bar on the chart. Okay? And look at that. Had you went into every big bar on this chart in the direction that it was going, the probabilities of it continuing were greater than 50-50. This one here, you did not continue. I mean, you traded above it, but you didn't continue. You sold off. This one here, you did continue down for a couple bars. Let's go see if we can find some more here. This one here, this had a long wick, big bar with a long wick. Wick's bigger than the candle though, so this was a long bar. This was a different scenario though, because this opened here and closed here, but traded down to here. So big green bar on the bottom of this big red bar. So if you were looking at the big green bar, you would go up. But typically though, when you see a big elephant bar like this, you want to be trading in that direction. Okay, if you're unsure, give the next bar time to rescale that bar and see how far it can go. If it goes up more than 50 or 60%, it's probably going to fail. Okay, but if it's able to get past 60, 70%, you're probably going to see some continuation to the top of that bar. But what makes this high probability for a short is that you are below the moving average, and the same thing we just talked about, lower highs. All the way down, lower highs, lower lows, okay? And you just broke this swing low here with that move. With that last move, you broke this last swing low, okay? So it's higher probability that this is going to continue down than it is that it's going to go up. And it's low risk. It's low risk because you only have this bar right here, and you're risking about 6 points, about 7.5 points, okay? Get rid of some of that. Okay. Go down here to this trade right here. This is a medium probability, but a low risk long. Okay, so that's here on the chart. Medium probability and low risk. We're right here. Okay. Why is it medium probability? Well, it's medium probability because you're in a downtrend. So that takes away some of your probabilities. Okay. You're in a downtrend. But this bar is a big bar, and it just reversed a pretty nice sized bar. It just engulfed that bar right here. You see that? So the engulfing right here makes this a medium probability. Also, you have support down here from where it turned around before. Okay, you have some support down here that this area was sensitive before. It came down. It was resistance, resistance, resistance. Broke through it. Support a little bit here. flipped here, resistance, 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 came back down, shot up through it, came back down, acted as support. So this is a sensitive price area, okay? But it's still medium probability because you're below the 20-period moving average. The only thing that makes it not low probability, low risk, is because you have this bullish engulfing bar right here. So this is showing you that not only are they buying here, but they're buying so much they were able to overwhelm the last set of bears that sold, okay? And your risk is low because you're below here. Okay, last one for this video. Here you have a medium probability, low risk long, okay? Medium probability, low risk long. What makes it medium probability? The same thing that made this medium probability makes this medium probability, all right? You have now another big bar. You're going to go long when this bar closes, and you're going to put your stop below that big bar. All right? You could put your stop here at the low, or even here below the swing low, but this would turn this into a medium probability high risk trade. Okay, and that's what we'll get into the next video. You'll turn this into a medium probability high risk trade because you're risking a lot more on the way down here than it should take for you to admit that you're wrong. Okay, this is a 2-minute chart. That's about 12 points, 13 points, 12 points. Okay, when the low risk trade was here, it was up here at 7 points. All right, so if you're risking 5, 7 points a trade and all of a sudden you're risking 12, 13, 11, you could probably cut that in half and have 2 trades out of here. Give the market 2 ideas and see if it agrees with you. But this is medium probability because now we have a bullish engulfing, okay? It's taken out a previous swing high, all right? And it's taken out the moving average, and we just had a lower low. So it's probably, if I were putting it on a scale, because this one was also medium probability, so this will be low, and this will be high, right? And then this would be medium in the middle. I can't really draw, hold on. Okay, this would be medium right here. Okay, this trade would probably be right here. Okay, because it was also medium probability. But this trade would probably be a little bit further to the high probability side because of all the things that we just discussed with this. Okay, being above the moving average, bullish engulfing, breaking structure to the upside, breaking this last swing high. And also you've had two now swing lows that have held. You had one here, and then this is a higher low here. Okay, really 3 because it came down and tried to do this again. All right, and it's low risk because you have put your stop below here, and you said, okay, if it breaks below this big candle and the candle that started this move, I'm going to be out. And this trade obviously ran a pretty good distance here. Okay. So I hope that gave you an idea of where I'm going with this series. The next one that we're going to talk about, that I said we get into, the next video is going to be about this situation here. Okay. Situation here is what we're going to talk about. When you have a situation where you have a high risk, high probability trade. Okay, and what that looks like, and what you really see is that in order to take this kind of trade, you really need the probability to be very high and the risk to just stay high. Okay, so this trade is in a category of its own, and it deserves its own kind of video, and I'm going to show you a kind of trade that I took like that recently. It was very high risk, but it was also it was high risk, but it was also very high probability, and it worked out. So we're going to talk about this in the next video. Give me a thumbs up, give me a like. Appreciate you guys watching to the end, and I will see you in the next one. All right, peace.